Day one of the new year, and a brutal day it was. All the major indices in the dumps as the dollar advances, and 2023's most loved stocks were dumped for safety. So as bulls lick their wounds, let's assess today's sell-off and discuss, do we see a longer term sell-off upon the horizon? Hello everybody, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. We do the most concise and informative daily stock market recaps on YouTube. So go ahead, subscribe, like this video, let's get into it. It was a brutal day for technology. Apple led technology lower after a few analysts downgraded their stock as a whole based on what's going on with their Apple Watch. Semiconductors were also sold heavily, and I think this was on the news of ASML barred from selling their products to Chinese firms. But healthcare, consumer defensives, energy, real estate, utilities, and financials, particularly banks, outperformed the market. It was really just like tech and the big names, Amazon, Tesla, Google, Costco. They were really the ones that were kind of just sold off today. And breadth in the market overall was actually not bad. Look at the advances and decliners. Now you may look at this and say 3,000 decliners, 2,600 advances, but if you include the people who were flat, it was about 50-50. But the latest weekend poll is finalized. 59% of you are bearish, and for good measure, you had a brutal day today. And for those of you that are short, congratulations, bears are licking their wounds. Now let's have a look at the majors, and something I saw absolutely nothing about on Twitter was the RSP. The RSP was positive today, but Treasury bonds, the S&P 500 and the IWM were all down about half a percentage point, and the Nasdaq, led by Apple, was absolutely brutally sold off. And I do think that if Apple continues to go lower, tech as a whole is going to continue to go lower. Now here is some very interesting stats when we've had day one in the year negative after we've had a 10% run in the Nasdaq and S&P 500. In the Nasdaq, we have a positive day 2, 3, 4, 5, and 6 for an average return of 2.32%, 8 wins, 0 losses, 100% win rate. Very much the same for the S&P 500. Day 1 is negative, day 2, 3, 4, 5, 6, normally positive for an average return of 1.93, 8 wins, 1 loss. That's 88% positive. Very positive stats. Looking at sectors as a whole, what performed the best? Healthcare, utilities, staples. What performed the worst? Semiconductors, software, technology. No surprise there. And the two best performing sectors, semiconductors and home builders, for 2023 was sold off pretty brutally. Now, let's dial into the sectors that performed the best. And these sectors, right, telecom services, staples, utilities, healthcare, they're called the SHUT index. These sectors will perform the best. They're often considered defensive sectors. And what we've been seeing in these sectors is not just buying today, but buying over the month of December. We've seen insiders buying significantly in the XLU. The same is true for the XLP. Healthcare too. You could see huge amounts of buying in the healthcare sector right here. And similar situations happened in 2011, 2012, as well as 2020. And the average returns 1 year later after these buy signals triggered was about 15.75% of the time, 100% of the time higher. And I think this was a bit of getting on the defensive side as well as getting into stocks that underperformed in 2023. Look at the sector overview for 2023. This is healthcare, staples, utilities. They were the worst performing sectors of the year, as well as energy, who put up a pretty good day today. So the underperformance for 2023, a lot of people were probably just selling tech, selling comm services, rotating into year, as well as a lot of people maybe just trying to get defensives in their portfolio, thinking that maybe a recession is coming. Let's talk about the Santa rally. We were positive up until today, and now we're sitting marginally negative, and everything is going to come down to day 2 of the Santa rally. Whatever happens here today, a negative day will be a negative Santa rally. A positive day, as long as it's more than this, will either be an even or positive Santa rally. So a lot comes down to tomorrow, and this is part of my January trifecta, and we're going to talk about that a little later on in the video. Volatility is the price we pay for 10% in annual market gains. Now guys, this is the S&P 500 return since 1980, the max pullback and the average pullback. And you could see that the S&P 500 has an average pullback, an average drawdown from peak to trough of about negative 14.2%. And that can come at any point in the year. That could come at the start, the middle, the end of the year. It really depends where we are in the cycle, an election cycle, where we are with stocks, earnings, recessions. It really just depends. But I just want to let you guys know that volatility is completely normal in the market. There are some worrying signs that we did see in the market. Now, some people say this happened, some people say it didn't happen. It depends on your provider. But the US 1-month bond spiked yesterday upon the open to 6.128%. So could this be something sinister happening under the wood? Could it be a mistake from a provider just quoting wrong? I don't really know. We probably won't get the answer to it, but just something to consider that the 1-month government bond did quote at 6.128%, and that's very, very worrying, all things considered. Let's talk about the economy. GDP, the Fed's GDP now is estimating Q4 2023 GDP at 2.3% right now. Very strong numbers. And continuing to look at the economy, Jolts, we get Jolts data this week. Jolts opening, coming off their highs from March 2022, but still well above the historic average trend. Look at Jolts quits coming down and layoffs slightly moving up, but take these into context that we are at one of the tightest labor markets ever and still historically at low levels, both in the layoff departments and the quits departments. Now, diving into consumers, household debt service ratio at record lows, and that's because people are just making more money right now. 9.9%. Looking at flows into early delinquencies, most into auto and credit card. Student loans does worry me a bit, because if we do get to these levels right here, debt service will probably get to where the average level was over the last 10 to 20 years. That being said, the consumer balance sheet is actually kind of crazy. $171 trillion in total assets, only $20.3 trillion in total liabilities, the majority being mortgage. 66% of total liabilities being a mortgage. Now, let's dive into this a bit deeper, right? So let's add some margin of safety. Think about it. Homes. 29% of total assets or equity is in homes. Now, let's remove this because it's really hard to pull equity from your home very, very quickly. Let's remove pension funds because this money is not really easily accessible, and other tangibles. We'll remove other tangibles too, because let's say someone has an art painting, it's worth $4,000. How long is that going to take you to sell? A while. So that leaves us with other financial assets, deposits as the two major assets that we look at, right? So assuming 29% homes, 5% tangibles, 17% pension funds, that's 50%, right? So reduce this number by 50%, we get about $80 trillion in assets, still 4 times more than what total liabilities are. In other words, consumers are flush with cash in assets, and they have a lot of assets in terms of deposits and other financial assets that they can draw on to really support their spending in 2024. And consumers are also expected to hold on to their wage gains in the US, Euro, and UK area. Wage inflation is at about the 4 to 5% level. It is expected to decrease to about the 2 to 3% level in 2025, 2026. But as it stands right now, consumers are flush with assets and they are holding on to their wage gains that they have made over the last couple of years, which is outpacing inflation on a 6-month annualized basis. And another tailwind for the consumer is refunds. We are expecting 2023 refunds to start to come in. The first 4 months, the first quarter of the year shows the biggest refunds, and we are expecting about $200 billion worth of refunds in 2024 over the next 3 months, simply because the labor market has been extremely tight and there's been some solid wage gains, all things considered. Now, the consumer is looking strong, but what about companies, businesses, the S&P 500? And according to earnings growth is expected to accelerate from 0% in 2023 to 11% in 2024, 245 on an earnings basis, and 276 earnings per share in 2025. That's 11% and 12% growth respectively. Margins are also expected to stay the same in 2024, and right now they're sitting well above the historic average. But if you actually have a look at it from about 2016 to 2019, they're at about the average in this area right here, although they have been decreasing quite significantly, and a lot of this has to do with rate hikes. If rate cuts do come, we should see better margin in 2024. Earnings revisions are actually improving. This is the global earnings revision ratio. It improved from 0.66 to 0.82 in December. It went from here to here, which is about the average since 1988. Quite a lot of data right there, and that's really good to see. So we should be holding on to these earnings gains as a whole. Now, there are risks in the market. The biggest is small caps, and right now 41% of small cap companies are unprofitable in the Russell 2000. Now, a lot of these are new companies coming in and they're looking to make a profit over the next 2 to 3 years, but this is well above the historic trend since 98. And if you actually have a look right here, 06 all the way to this area where we are right now, this is zero interest rates, okay? And as we've had zero interest rates, it's much easier for companies to be unprofitable. Zero interest rates are no more a thing. We're sitting at a 5.5% federal funds rate, and we really have to see what's going to happen to small cap companies and bankruptcies in 2024, 2025, 2026, and all the way up to 2030, because the debt maturity wall in small caps is quite significant. 47% of small cap debt is maturing between 2024 and 2030 in the next 6 years. Very interesting. And then after that, not so much. Large caps too. The reason why I don't worry about large caps is if you have a look at the floating rate debt, 38% of small cap debt is floating rate, whereas for large caps, it's only 6%. And this is why this and this is so concerning, especially in small caps. Small caps held up pretty good in 2023, and we'll see if they continue their momentum in 2024. And do take into consideration, this is the Russell 2000. It's literally the bottom of the barrel. If you do want a really good small cap index, look at small cap quality or the S&P 600. Let's talk about the global economy, and very similar to what we're seeing in the US, earnings in every country except China is expected to turn up. I mean, Japan, emerging markets, Europe too, earnings are expected to grow. And have a look at Europe. Europe is expected to post their best earnings since 2008 around that period, and they're only trading at about a 13 PE. So there's definite value in some of the Europe indices, and you could be looking at something like the stocks 600. That's a really good index that you can go buy, and you get just the biggest and best companies in Europe, and probably the main earners. 90% of earnings are in the stock 600. Just something for you guys to consider. Let's look at global GDP up to 2028 year over year. Europe is actually expected to grow just below the US just above 2%, but the biggest winners are going to be India, China, and emerging markets. Now, one of the biggest concerns globally is actually the working age population. This is actually decreasing in stuff such as Europe, China in particular, Taiwan, South Korea. China had some terrible one-child policies that really led to this situation right here. But India, guys, India could be a stock market that we should really start to be looking at, because look at that, 92 million population growth over the next 10 years. And that's on top of what we already have right now. Same with Southeast Asia and US. The US is in a really, really good situation. I think a lot of this has to do with immigration. Now, let's go back to American companies, and we could see CapEx start to pick up. CapEx expenditure has really been on a downward trend since the COVID high, and we are probably starting to see it pick up again. Now, this is what I use right here. New orders, non-defense capital excluding aircrafts and durable goods. You put these two lines together and you do get a barometer for what CapEx could be doing. And we could see CapEx start to pick up if rates do come down. Now, what is projected to happen for interest rates? In January, the Fed is expected to keep the rate at between 525 to 550 basis points, but they are expected to cut 25 basis points in March and then increase in May. Apparently, futures are a bit wonky at the moment. This tells me that the market is just undecided as to when the first rate cut is going to occur, March or May. They're still undecided, and that's why they're going between the two. But throughout 2024, we are expected to see a federal funds rate at about 3.75 to 400 basis points. That's about a 4% federal funds. Still a bit high if inflation gets to 2%. I think if we are going to get a 12-month annualized inflation rate of 2%, maybe even 1.9, federal funds should be at 2%, maybe even 1.5, just my take. Now, here's the data after the Fed's last rate hike. We had our last rate hike in July, and this is where we are right now. This is the 10-year and the S&P 500. And normally when the Fed is done cutting rates, we see exponential returns in the S&P 500, 30-40% plus. 1994, 60% plus in just 24 months. The only outlier, 1000, and we do know what happened here. Looking at the 10-year, very much the same thing. Bond prices normally do increase quite significantly after the Fed's last rate hike. Now, based on where we are right now, guys, here and here, okay, there's still a long runway for growth in the S&P 500. Now, inflation is at the Fed's target on a 6-month annualized basis. Inflation is at 1.9%. And this is the reason why we saw quite the rally in December. And if we continue as we have, we should see a 12-month year-over-year annualized inflation basis, CPI, at about 2%, which is the Fed's target. And a lot of you have been asking me, why, if the economy is roaring, the consumer is so good, unemployment is so great, why does the Fed need to cut rates? And it's quite simple. The Fed funds right now is at 5.5%. If the Fed doesn't cut and we get a 2% inflation rate, this 5.5%, the Fed is too tight, and this 5.5%, and that will bring on the recession. This means the Fed is too tight at 5%, the Fed is too tight, and debt service will be too high based on the annual GDP growth, and that'll really compress margins and really hurt the consumer, businesses, and just everybody as a whole. And that's why the Fed needs to cut, because real Fed funds will be too high based on CPI, and it's a balance between the two. Let's talk about seasonality, move into what we expect this week, this year as well in the S&P 500. Now, this is my seasonal chart that I go off every single year. It looks at everything from 1950 to 2023, puts extra weight onto the last 11 years, looks at earnings growth as well as the current yield, and then fits a number. That number this year was 8.01%, excluding dividends. And this is what an 8.01% is what my models indicate the return for 2024. And this, what I found interesting is that from about here, May, all the way to here, October, the market will be trading relatively flat in this area. We really only get big runs from about March to April, and then October to December. So very typical seasonal flows to what we saw this year. We saw an early run, but ours was up until July. Then we saw quite the drop and then the rally. Generally speaking, the seasonal pattern doesn't look much different year to year. Now, this is the January trifecta. We spoke about this earlier on in the video, and it is the Santa Claus rally, the first 5 days of January, and the January barometer. If all three are positive, 90% of the time, you can expect an average return, 17.7%. It is higher 90% of the time. And now this is triggered 37 times. In those 37 times, there have only been 2 losses. Kind of crazy. 35 wins, 2 losses. Very, very positive. Now, the Santa rally is on the ropes. The first 5 days of January is on the ropes. But the January barometer, which we'll talk about in later videos, is still well within positive territory. And this spans quite a number of months. And all in all, if this is positive, we can expect a very positive year. And this is the number one risk on signal that I use for the year. And we will know what all of these will be by the 19th of January. Now, there are some risks building under the hood, something I want to make you guys aware of. The gamma strike has moved to 4,800. We were at this level right here, 4,850. And the gamma flip zone, negative gamma zone, is 47.45, and we're sitting right on this level. If we do get below here, we could see some pretty vicious sell side, anywhere from 5 to 10% in the S&P 500. And we have spoken about this last week, that there are risks building. And something I want you guys to note, have a look at this. This was gamma at the start of the session. This was gamma at the end of the session. Look at all of this negative gamma building. And these are the days when they expire. And when this gamma expires, these dealers need to unwind their hedges, and that unwinding will be to sell S&P 500 futures. So just something to be aware of, all things considered. And looking at the gamma heat map, something I want you guys to notice: huge amounts, strong gamma from the 47.10 level sits here, and this is where we bounced. Just above the 47.20 level, we came all the way down, bounced here, and there was strong support into this neutral gamma pocket right here, just below the 47.40, 47.50 level. Now, I think that based on what I just showed you in the previous section, the gamma, the negative gamma that built up into the tape, this chart is going to look insanely different, and I am going to post it on my Twitter. So go ahead and follow me on Twitter, and also go ahead and watch this video right here if I remember to put it up. This will show you how to neutralize your delta, how to hedge your entire portfolio, so that for every 1% move in your portfolio is a 1% move in your hedge in the opposite direction. But as it stands right now, we are still in a positive gamma condition. Dealers do buy dips, sell rips. As we have seen right here, this is not out of the ordinary, although the volatility was higher, but we did see the VIX spike 8% or so today. So everything was well within normal trading conditions, and the S&P 500 was only down 0.57%. Quite a normal day in the market, although some bears were saying it's the cusp of a new bear market. Kind of crazy what's going on. But let's have a look at some charts. S&P 500, we rejected at about the 4,800 level, this gamma resistance, the strong gamma resistance we rejected a couple of days ago. And this red line is the gamma flip zone. This is where we are right now. If we do probably get a couple of days closes here below, we could see selling to 4640, 4600 even, guys. It could really be that brutal in all the way up to OPEX. We have to see what tomorrow's trade brings. Just very early in the session. If we do get like a green day and a positive Santa rally, I think that is probably going to be risk on. That being said, all dips are buying opportunities for 2024 because I am bullish on 2024. But if we do get a 5 to 10% dip, that would be awesome. Looking at Russell, because of how weak small caps have generally been, I mean, they have been super strong, but you pull up like the chart of the last 2 to 3 years, they've been significantly weaker than the S&P 500. They really do need to consolidate above this 198 area and not move any bit lower. I do think if they do go lower, I think selling will just continue in the Russell. TLT, as long as TLT stays above this 200 moving average, does look like it wants to roll over, but as long as it stays above here, I'm still bullish in TLT and bullish for bonds as a whole. I am bullish at the up until the 109 level for TLT. Looking at the equal weight, guys, equal weight put up a positive day today. Not many people realize this. Equal weight was positive today, and this does look significantly stronger than the Russell. And if we do get to even the 155 level, I'm still bullish on the equal weight going. Bullish on the equal weight this year than the market cap weighted index. Looking at Google, it had a red day, and fundamentally, I really like the stock. So much money, so little debt, huge businesses, 254 acquisitions in 3 years. The company is really moving forward, and the lower Google goes, the more I like it. And hopefully we can get to this level right here. That would be really, really fun. I regret not buying more in March. I really do. I really should have put my life savings into it. Looking at Apple, guys, I think we're going to the 200 moving average. I think that's where we're going to get with Apple. I do think we're probably going to go lower to this 180 area, and this is where we'll consolidate, and then the market will do some price discovery around this area in Apple, and this is going to be a headwind for the Nasdaq and the broader market. Looking at Celsius Holdings, up 8.27%. We spoke about this one last week. We were looking at potentially buying it at its 200 moving day, but it looks like it's just going to go higher, and I do think anywhere from $50 to $60 is good. I see the stock moving 50% in 2024. Maybe I'll buy some tonight. I'll let you guys know in tomorrow's video. Looking at Bitcoin, absolute rally. It did come well off its highs. It was up 8% at one point. But like I said, remember last week, it was coiling in this range and it shows this direction it's going up. And it probably means Bitcoin goes higher into 2024. Looking at S&P 400, mid caps, very, very similar to what the Russell is doing. It needs to find support and look to higher price action. Otherwise, there could be some, sell side all the way down to some of these key support levels, 2,500, 2,600, around there. Looking at ASML, now there was some pretty bad news here in ASML. With regards to some of the shipments, some of their customers in China. The Dutch government has barred them from shipping their products to Chinese firms. And this is just more headwinds for China and minor headwinds for ASML. Still extremely bullish on the stock. And I do think that the stock is trading well under where it should be. It, as a monopoly, it's the only UV lithography provider for semiconductors in the world. The only one. There are other competitors building theirs. But as it stands right now, they have the leading market position, 100% of market share. And I don't think anybody's going to overtake them in the next 10 years. A plus stock. If we can get to the 680 level right here, this 200 moving day, guys, I think this is a really, really strong buy and a really long-term hold, all things considered. Looking at NEO, and we said that one of two things need to happen. It needs to break and close above this line. It did not. We'd probably go back to $7. Looking at Tesla, and the fundamental picture has changed for Tesla. We did say it was consolidating, but it released its numbers today. Its vehicle output for Q4 2023 came in better than expected, and they are looking at 1.8 million vehicles delivered for 2023, I believe. And that's why Tesla came off the lows right here. And it's really hard to say what this will mean for the company. We'll have to see what tomorrow's trade does. But what Tesla really needs to do is break this level right here and then break above this level right here. But as long as it's above its 200 moving day and using this trend line as support, the thesis of a breakout is still intact for the Tesla bulls. This is XLV healthcare. Absolutely crazy, 1.76% up on the day. Really crazy. And I do think healthcare is going to perform really well. 19% growth calendar year 2024 is expected for healthcare. It's broken above this key resistance right here. If it pulls back, uses it as support, that's going to be very bullish. Otherwise, I see 150 for healthcare in 2024. Looking at financials, very similar to healthcare, the chart's just not as zoomed in, but up 0.43% in a day where the broader market was down. And this is looking healthy. I think financials need to continue just trekking up, building bases of support and trying to hit that 41, 42 area in the XLF. Regional banks followed financials positive. I still think that the 56 area is what regional banks need to go and take. They really want to look for further upside into 2024. And, I don't really like this price action I'm seeing, all things considered. Now, Marathon Holdings down for the day despite what Bitcoin did, and we have to see where this pulls up. But I was looking at the financials, looking into some of this, and Bitcoin miners, I'm not that bullish on. I think the business model, a lot of people can enter the business really quickly, really easily. I don't think they have any real competitive advantage, and it's good for trades. I mean, if you can get to this, if it gets to this 200 moving days, I know it's a 50% decrease, get that, maybe look for a buy for a swing upward. I don't see any competitive advantage in holding something like Marathon Digital. Not bearish, not a bear, just saying I prefer to hold high quality compounding companies in the long term. And if I was to choose between Google and this stock 5-10 years down the road, I can guarantee you which one will produce more alpha in your portfolio, and that is Google. Looking at the US dollar now, the US dollar did spike up quite significantly compared to a lot of the other G7 currencies. This is going to be a headwind for US equities, but it could be a one-day thing. A lot of it had to do with oil and what's happening in the Red Sea, the geopolitical news. Now, I'm not qualified to talk about that, but yeah, the US dollar is moving higher, and we'll have to see where it holds and finds resistance, maybe at the 200 moving day, but that just means a stronger dollar is not looking good for earnings into 2024, as well as just the global trade. It's better for the US dollar to be weaker in 2024, considering all the strength it had, especially here, in this up to November in 2023. Looking at data, Jolts. Tomorrow we have Jolts, the FOMC minutes. A lot of people think FOMC minutes is going to be quite hawkish, as well as some ISM data. Then on Thursday, we got jobless claims, ADP employment, global composite S&P PMIs. And then Friday, we got quite a number of data points, anything from non-farm payrolls, ISM, services factory orders. And it's going to be really good to see where these are, as well as labor force participation and average hourly earnings. So a big week of data coming off last week's light week, and we're sort of making up for it this week. And there's a lot of risks here in earnings, guys, but we really have to see how this looks moving forward. If you've made it up until here, thank you so much for watching. If you like this video, guys, please subscribe, leave a like, a comment, hit the notification bell, guys. Cheers.